Hi guys, I'm Vinny. I recently retired at 47 years old after being made redundant for the second time in my career. I decided to start making some YouTube videos documenting my retirement journey. I posted my first video about a week ago and I was absolutely blown away by the reaction. Lots and lots of comments, lots and lots of views. I've obviously struck a chord with people who've already retired or people who are looking to get out as soon as possible. A common question which I was asked on that video was, what does your portfolio look like? So what I thought I'd do, I'd put together a video just explaining how I'm able to retire at 47 and a pretty high level view of what my portfolio looks like, just to give you guys an idea of how I'm able to get by without touching my pensions. I come from a very poor working class background. I saw my parents struggle financially for years and years. I didn't want to live my life struggling, and I realised that the responsibility for that was on me and nobody else. Just to be clear, I've never had a helping hand from anyone. I've just worked hard and made a lot of sacrifices in my career. I started saving from a very early age and I started to invest much of my salary from my early 20s onwards. So let's crack on with some detail. A quick disclaimer, I'm not a financial advisor, so don't take any financial advice off me. I'm just going to explain to you what's worked for me and how I've managed to build up my investments. So number one is pensions. As soon as I landed my first corporate job, the first thing I looked at was the pension scheme. I never trusted that the state pension would always be available. So from a very early age, I decided to start investing in private pensions and just make sure I had a safety net, just in case the state pension wasn't there for whatever reason. The first thing I did was take advantage of the maximum possible company matching. Most companies I've worked for have two levels of pension scheme. There's the basic scheme, which most people just sign up to as a default, and there's the enhanced scheme. As soon as I started my first corporate job, I wanted to make sure I took advantage of the maximum possible company matching on my pension. And I've done that in every single corporate job I've ever worked in. Most people would just stay in the basic pension scheme where the company took a minimal amount of money from your salary. I would always take advantage of the maximum matching pension scheme or the enhanced scheme, where you would sacrifice a bit more money, but the company matching would increase. I just saw that as free money for a little bit more sacrifice on my side. Another thing I would do with pensions from a very early age, I would use something called AVCs to increase my pension contributions. So an AVC is an additional voluntary contribution, and all that means is you can take a chunk of your salary, you can sacrifice that salary so you don't get it in your pocket, it goes straight into the pension scheme, and what happens is the government don't tax you on that portion of your salary. So from my early 20s, I was sacrificing a portion of my salary and I was putting that sacrificed salary into AVCs. And I've been doing this for over 20 years now. Every company I go in, I immediately find out if I can make AVCs. If I can, great. I sacrifice a portion of my salary and make those AVCs, and I'm able to build up a pension pot much more quickly than people who are in the basic pension scheme. So I was able to build up significant pensions using that method. Now I can't touch those pensions for at least another 8, 9, maybe even 10 years. Can't remember the exact figure. So the other thing I used to do, I would also take a portion of my salary and I would invest that separately to the pension. So that brings us on to number 2, which is stocks and shares. In my early 20s, I became really interested in investing after I read a book called Rich Dad Poor Dad by Robert Kiyosaki. That book started me on the path to investing, and I started to read more and more financial books in my 20s just so I could teach myself about things like stock markets, investing, index funds, all those type of things. I really like the idea of buying chunks of big companies and then receiving profits from those companies in the form of dividends. And in my early 20s, I started regularly investing a chunk of my salary in the stock market. I was primarily buying shares in big British companies that had regular dividend payouts. In 2007, I was made redundant after my job was outsourced, and I received a pretty big redundancy payoff. Rather than spending that redundancy money, I immediately invested it into the stock market, and I found another job within a couple of weeks of being made redundant. So I never touched that money. So that money's been invested in dividend stocks on top of all those other regular contributions I was making every month. So that redundancy money has had something like 2 decades of growth or something like that. And I've continued to buy more dividend stocks on a monthly basis. I always follow a cardinal rule in the stock market. I never ever touch my dividend payments. As soon as I get dividend payments in, I let them build up for about a month. And what I do is I add that money into my regular stock market contributions and I just buy more stocks. So dividends come in, I let them stack up. I reinvest them in the stock market. I've followed that rule for over 20 years and that's paid me back really, really well. Dividend stocks provide a pretty substantial portion of my income and I can live off those dividends for a while before I even start to collect my pensions. As I've mentioned, I primarily hold UK stocks. I don't actively invest in the US stock market primarily because of tax reasons. I would highly encourage people to invest in dividend stocks if you can. I know that buying stocks directly is more risky than things like index funds, but let me just quickly explain my attitude to risk. If I get some money in from a salary, I could spend that money on, say, buying a car, I could buy a TV, I could buy a sofa, I could spend it on some fancy gadgets. That's how most people treat their salary. They get the salary, they spend it on stuff. Instead of taking my salary and spending it on gadgets or stuff or designer clothes or cars and things like that, as far as I'm concerned, once you spend that money on stuff, that money's gone anyway. So my attitude is I'd rather keep that money and I'd rather put it into the stock market, into dividend stocks, and at least then I'm earning money from those dividend stocks. Whereas if I'd have spent that money on stuff, gadgets or clothes or wherever, the money's gone anyway. So I see it as fairly low risk to take it and put it in the stock market. If you are looking to get into buying stocks, I learned much of what I know from an author called Robbie Burns. He's got a fantastic book on trading. There's a link in the video description if you want to go and check that out. Highly recommend it. It's really easy to understand book and it's a great introduction into trading. So go and check that book out if you want to get into stock trading. A few people have asked me which companies I own stocks in. If you want me to go through the companies that I buy in a little bit more detail, I'm happy to do that on another video. But just a few off the top of my head. Admiral, Aviva, Legal and General, BAE Systems, Drax, SSC. I own a few of the big drugs companies. Tobacco companies are fantastic, really regular dividend payers. I've got quite a lot in British American Tobacco, quite a lot in Imperial Brands as well. I could go on all day about what's in my portfolio, but as I say, rather save that for another video. My stocks are all held in a stocks and shares ISA, so I don't pay any tax on them. I pay things like dealing charges, the spread, obviously, stamp duty, all those kind of things. I mostly used an execution broker to buy my stocks called XO.com. Their dealing charges used to be really, really cheap, but they've crept up quite a bit over the last few years. So more recently, I've been using Free Trade. It's really good. They've got a fantastic app and you can buy straight from your phone. If you're looking to start investing in stocks, I do have a Free Trade affiliate link. It's down in the video description. If you sign up through that link, you get yourself a free stock. So go and check that out. Just a little bit of a plug there. The third thing I want to cover is index funds. I've invested in index funds as well. Most financial experts will say to you, buy the S&P 500 or buy the NASDAQ 100 or buy the FTSE 100. If you don't know what an index fund is, go and look it up. But essentially, it's a way to invest money in the stock market, but spreading it across an index rather than buying individual shares. So I do have a Vanguard fund that's invested in the S&P 500, so I do put money into that regularly. Being honest with you, I find index funds a little bit boring. I like to research companies and I like to pick my stocks directly. I know that's a little bit more risky, but as I say, index funds are a little bit too boring for me, but I have got some money in them. It pays to spread your money around. You don't want all your eggs in one basket. So yeah, I've got a decent chunk of money in a Vanguard S&P 500 fund. So that covers index funds. The fourth thing on the list is REITs. A REIT is a real estate investment trust. A REIT is essentially just a big company that invests in real estate and it pays out more than 90% of its profits back to shareholders. So a REIT will own property in areas like apartments, office buildings, industrial estates, shopping centres or shopping malls for the US viewers. I really love REITs. Some of them have really, really good dividend yields and they have a very consistent payout. The best thing about REITs is they allow you to invest in real estate without directly owning the real estate. So the REIT does all the hard work, they do all the management of the property, they collect rents and stuff like that. So a REIT is a good way of investing in real estate without getting your hands dirty. I've currently got quite a lot of money in REITs. I've been buying them for a long time. Off the top of my head, Big Yellow Group, Primary Health Properties, PRS REIT, Safe Store Holdings. These guys own property or shopping centres or industrial units, or in the case of Primary Health Properties, they own things like clinics and medical centres, and they just collect rent from that property and you just get it as a dividend. I absolutely love REITs. I'm always looking for new REITs to invest in. Fantastic source of passive income. I'm really looking to expand my investments into REITs over the next sort of 5 to 10 years. Fifth one on the list is premium bonds. They've got to be in there, haven't they? Premium bonds are a UK only investment. I've got a modest holding in premium bonds. I don't really see them as an investment. I just see them as a bit of fun. So if I do have some spare cash floating about, I'll often just chuck a few £100 in premium bonds. I don't treat them as a serious investment. I just see them as a little bit of fun, and you can win a big prize. The main advantage of premium bonds, of course, is you never lose your money and you can cash them in. So I almost treat them a little bit like an emergency fund. Number 6 is property. I've mentioned this on a previous video. I'm very, very skilled in DIY. I can pretty much do anything that's legal. I can even do things like plastering, which is pretty tricky for most people. About 12 years ago, I paid to go on an intensive plastering course, and I learned how to skim plaster to a DIY standard. That course has paid me back probably 100 times over. I bought my first property in my 20s, moved into it. It was completely run down. I spent a couple of years renovating it, doing it all up to a high standard, and then I sold it. And then I used the money from that property to invest in a larger property. I realised in my 20s that this was a pretty good way of moving up the property ladder without relying on massive mortgages from the bank. So at the moment, I'm just in the middle of selling a property that I own. I moved in with my girlfriend a while back, so my current plan is to split that 3 ways. So I'll put some into dividend stocks, I'll put some into REITs, and I'll put some into index funds. So essentially a 3-way split on that money. As soon as that money's invested, I can use that to bolster my retirement income as well. Number 7 is cash. By cash, I mean money in the bank or cash ISAs. I don't mean stuffing money under your mattress. Cash wise, all I have is an emergency fund in the bank to cover any unexpected expenses. The boiler goes, or the roof blows off the house, or the car breaks down and needs some major repairs. That's the only cash I hold. Cash ISAs, I've never really bothered with them, to be honest. The return on cash ISAs has been historically pretty poor anyway, and I prefer the stock market. I know the return on cash ISAs is better at the moment, but I've got so much invested in the stock market, that's just the way I prefer to go. So nothing really on the cash front apart from that emergency fund that I've got. Again, no cash ISAs, anything like that. I just don't bother with those. If for some reason I really got myself into financial trouble, I just break into my investments. But again, I've got that emergency fund in the bank just in case I need it. Finally, number 8, my second redundancy. I've now been made redundant. I was made redundant last week. I'm going to put together a video on that soon, just discussing my thoughts on redundancy. I've worked in technology for over 25 years, and my most recent job, I was there for over 16 years. I was in a senior position, so I got a really good redundancy payout. I'm planning to take that redundancy money and I'm planning to invest it pretty much in the same way as I'm investing the money from the property. So again, I'll probably do a 3-way split. I'll probably do stocks, REITs and index funds. I'll probably keep a little bit of cash aside just to top my emergency fund up a bit. A lot of my colleagues have already spent that money in the heads, and guess what's going to happen to those guys? They're going to have to go straight back to work. I'm not really interested in blowing that redundancy money. I just see that as another way to fund my retirement. Horses for courses, as they say. I've got no problem how people spend the money. It's their money at the end of the day, but I'd rather invest mine so I don't have to keep going back to work. So I think that covers everything, guys. Hopefully that gave you a high level look at my portfolio. Quick question for you guys. I know some of you guys have already retired, or some of you guys are planning to retire already. Where is your money? Where have you invested it? I'm always on the lookout for new ideas. So if you can give me an idea of where your money is invested, I'd really love to hear from you. Drop me a comment below. I'm always on the lookout for new ideas. So if you guys have got any great ideas, just drop me a comment. So I hope you enjoyed the video. Thanks for watching, and I'll see you on the next one. Take it easy, guys. Cheers. Bye for now.